Hey everyone, welcome back to Corporate Decoder. Today, Libity just filed its annual report for 2025, and I'm seeing a clear sign that this company is fighting for survival. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company, formerly known as Investcorp AI Acquisition Corp, is really struggling to find a business to merge with, and its financial situation looks pretty dicey. So let's dive into what is going on with Libity. This is a company that is essentially a shell, meaning it was created just to find another company to buy or merge with. They've been trying to do this for a while, and they've gone through several name changes, which usually suggests they're trying to rebrand due to a lack of success. Their main goal is to find a target business to combine with, and they have a deadline to do it. If they don't, they have to return the money they raised to investors. This is a common structure for what are called special purpose acquisition companies, or SPACs. A big red flag here is that their securities were delisted from the Nasdaq stock exchange. This usually happens because the company isn't meeting the exchange's requirements, often due to financial trouble or not fulfilling specific business objectives. Trading on Nasdaq was suspended in May 2025. And they've moved to the OTC Markets, which is a much less regulated and less liquid trading place. This means it is harder for people to buy and sell their shares. Even though they were delisted, they still have to file these reports with the SEC, which is good for us because we get to see what is really going on. This is their annual report, a big one that covers the entire year. We're looking at the year that ended in December 2025. And yes, they explicitly state they are a shell company. This is key. It means they don't really have ongoing operations, just a plan to find a business. As of mid-2026, they have just over 6.4 million Class A shares and only one Class B share outstanding. This is very low and shows a massive reduction from when they first went public, mostly due to shareholders redeeming their shares. They've got a whole section warning that many statements are forward-looking and involve risks and uncertainties. This is corporate speak for we're not sure any of this will actually happen. They mention things like completing a business combination and their new sponsor's ability to fund operations, which tells us their sponsor might be their lifeline. Let's get into the business itself. They were formed to find a business to combine with. They've had a lot of name changes, and importantly, their sponsor changed. The old sponsor left, and a new one, Samara Special Opportunities, took over in August 2025. This new sponsor is now responsible for funding their ongoing expenses, which is a pretty big deal. Back in May 2022, they raised about $260 million with their IPO. Each unit came with a 1.5-share warrant. They also sold private warrants to their sponsor for another $16 million. That money was supposed to go into a trust account meant to be used for the business combination or returned to shareholders if they failed. This is where things get rough. They've had to repeatedly extend their deadline to find a business to merge with. Each time they extend, a lot of shareholders choose to get their money back instead of waiting. In August 2023, over 16 million shares were redeemed. In August 2024, another 8.3 million shares were redeemed. And then a massive 1.4 million shares were redeemed in May 2025. This draining of the trust account is a major problem. Think about it this way, they started with over 25 million units and now they have just a tiny fraction of shares left that could be redeemed. By May 2025, after more redemptions, only about 26,000 shares were left that could be redeemed, and the trust account had less than $500,000 in it. They then pushed the deadline further to May 2028. It is like they are just delaying the inevitable. The biggest change in 2025 was the sponsorship switch. The old sponsor sold their stake to Samara Special Opportunities for just $1. This new sponsor is now footing the bill for all the company's expenses. This is a huge gamble for Samara. Now, they have a potential merger target called Blue Finance. They signed an agreement in April 2026, but this is still just an agreement. It involves several steps, including the formation of a new company, new pubco, and a merger. The implied value of Blue Finance is around $300 million. Blue Finance is a UK-based technology company focused on consumer lending. They operate under strict regulations from the UK's Financial Conduct Authority. It is important to note that Blue Finance's revenue is in British pounds, while New Pubco will report in US dollars. So currency fluctuations are a risk. This section is always a goldmine for what could go wrong. They might not finish the Blue Finance deal by the deadline, which is November 2026. If they don't, they'd have to find another target, and their time is running out. Because so much money was already taken out of the trust account through redemptions, there might not be enough cash left for the combined company to operate smoothly after the merger. They are also not guaranteed any additional financing like a PIPE deal. This is a big one. Their board didn't get an independent opinion on whether the deal is fair financially. This means shareholders don't have that third-party assurance that they are getting a good deal. The people in charge have a lot to gain if the deal goes through, but their stakes become worthless if it doesn't. This creates a potential conflict of interest. They really emphasize the trust account issue. This is the doomsday scenario. If they don't find a business by May 2028, they shut down and give whatever is left in the trust account back to the few remaining shareholders. Their survival hinges on the current sponsor, Samara, continuing to fund them. Samara has loaned them money, but they aren't obligated to keep doing it. If Samara pulls the plug, the company likely collapses. This is the most serious warning an auditor can give. It means they're not sure the company will be around in a year. This is a huge red flag, similar to what we saw with Bed Bath and Beyond before its troubles. As mentioned, they are now trading on the OTC Markets. This is generally a sign of trouble, making it harder to invest and potentially leading to price manipulation. Think of companies like Radio Shack, which went through similar phases before eventually disappearing. They've had serious problems with their internal financial controls. They found a material weakness because their review process was faulty, leading to mistakes in their accounting. They've had to correct errors and are still working to fix these problems. This raises questions about the reliability of their past financial reporting. By the end of 2025, they had only 3 holders of their class of shares. This is incredibly low and shows how few people are still invested. This is where management explains their situation. They basically admit their main problems in 2025, the Nasdaq Delisting, the continuous redemptions that drain their trust account, and the sponsorship change. The Blue Finance deal is their big hope. Here is some accounting drama. It turns out they underpaid shareholders who redeemed their shares in May 2025. They didn't include some interest and extension payments in the calculation. They had to make a special stub payment later in 2026 to correct this $155,000 error. This highlights the internal control issues we saw earlier. Of course they haven't, they are a SPAC. But look at the numbers. In 2025, they had a net loss of over $783,000. The primary reason was operating costs, but also a significant loss from changes in the fair value of their warrant liability. Contrast this with 2024, where they reported a net income of over $2.3 million. That sounds good, right? But it wasn't from business operations, it was mostly from interest earned on their trust account investments, which has now dried up because the trust account is so depleted that interest income dropped dramatically in 2025. By the end of 2025, they had only $1 in cash outside their trust account. Their working capital was negative. The trust account itself had less than $500,000. This is a tiny amount of money for a company that needs to complete a business combination. This is the crucial part related to the auditor's warning. They are completely dependent on Samara for funding, and there is no guarantee the deal will happen by the deadline. The management itself admits there is substantial doubt about their ability to stay in business for the next year. They account for their warrants as liabilities. This means any change in the value of these warrants directly impacts their reported profit or loss each quarter. This can cause wild swings in their earnings, making them look less stable. These warrants are a constant financial headache. They repeat the issue with their ineffective internal controls. They had bad accounting for expenses and legal fees, and they also had issues ensuring accurate payments to redeeming shareholders. It is a consistent theme of poor financial oversight. The new management is trying to fix things, but they admit these weaknesses are not remediated yet. It is a work in progress, and the results are still uncertain. The entire previous management team and board resigned when the new sponsor took over. This is a complete shake-up, signaling a new direction, but also a lack of continuity. The new officers are Vikas Mittal and James Dangerous. As of June 2026, the new sponsor, Samara Special Opportunities, owns nearly 70% of the company. The old sponsor, ISI Holdings, holds about 30%. This new sponsor is essentially the company now. This is the auditor's report. You can see it is from CB's CPA's PC for the 2025 financials. And here it is again. The auditors state that the company's ability to continue as a going concern is in serious doubt. They explain that if the business combination isn't completed by May 2028, the company will just liquidate. They also mention the lack of capital resources. This is the same warning as in the main filing, amplified by the auditor. Now let's look at the actual balance sheet. Total cash and cash equivalents held outside the trust account was just $1 at the end of 2025. Yes, $1. Total assets for the company are only $482,662. Most of that is in the trust account, which is basically money set aside for redemptions or the merger. Their total liabilities are over $1 million, including accrued expenses and those redeeming shareholders payable. which is money they owe back to people. This line shows the shares that could still be redeemed. At the end of 2025, only 26,021 shares were still subject to redemption, and the value they might get back is about $12.56 per S-share. This highlights how few public shares are even left. This is an interesting number. They show over $5 million in additional paid in capital for 2025. This comes from the former sponsor forgiving debts, which was treated as a capital contribution. It is not earned capital from operations. And then there is the accumulated deficit, a negative number showing how much money they have lost over time. At the end of 2025, it is nearly $6 million. Looking at how they performed financially, in 2025, they had a loss from operations of over $777,000. This is just their operating costs since they don't have any revenue from an actual business. In 2024, they had a huge amount of interest income from their trust account, almost $4 million. But in 2025, that dropped dramatically to just $284,000 because the trust account is so much smaller. This is why their reported net income vanished. They also show a loss of $290,000 from the change in the fair value of their warrant liability in 2025. This is that tricky accounting where the value of their warrants impacts their bottom line. So for 2025, they reported a net loss of over $783,000. Compare that to 2024, where they reported a net income of over $2.3 million. Again, that 2024 income was not from real business, but from that trust account interest. For class of redeemable shares, the loss per S-share in 2025 was $0.11. This statement shows how their shareholder equity has changed. See that big number of $5,050,793 under capital contribution debt forgiveness by former sponsor for 2025. That is not from new investment in the business, but from the old sponsor forgiving loans and bills. It is a financial accounting entry, not a sign of business growth. Cash flows tell you where the money is actually coming from and going. In 2025, they used over $2.2 million in cash for operating activities. This is just the money spent on trying to find a merger. Under investing activities, they show over $17 million providing cash in 2025. This looks good, but it is from withdrawing money from the trust account to pay back those redeeming shareholders. It's money going out to investors, not money generated by operations. And financing activities show them using over $16 million in cash, mainly for those shareholder redemptions. Notice the non-cash items, the accretion of shares subject to redemption, is how they account for the increasing value of shares that might be redeemed. This is another accounting adjustment, not cash generated or spent. Again, they confirm they have no actual operations and won't make money until the merger. They reiterate their dependence on Samara and the May 2028 deadline. The substantial doubt about going concern is highlighted again. They even bring in macroeconomic factors like inflation, interest rates, and geopolitical conflicts as risks. This shows how much the overall economic climate can impact a company that is already in a precarious financial state. This section explains how they treat shares that can be redeemed, because the redemption is outside their control. These shares are considered temporary equity, and their value is adjusted constantly, affecting the company's overall equity picture. And here is that issue again with the underpaid shareholders. They owe about $155,000 in supplemental payments because of an accounting error. This payment was made in May 2026, after the balance sheet date, but it is a direct result of problems in 2025. They confirm again that the warrants are liabilities, not equity. This means their value directly impacts their earnings and can't be treated as part of their core ownership structure. Looking at fair value measurements, they list their investments and warrants. Notice the public warrants are now classified as level 2, meaning their value is based on observable market data, but not quite an active market price. The private warrants are level 3, which means their value is based on unobservable inputs, basically management's best guess. They've moved the pricing of private warrants to level 2 as well, likely because even though they are private, they are now referencing the public warrant prices. This section covers things that happened after the 31st of December, 2025. The big event is the Blue Finance deal signed in April 2026. They detail how the companies will merge and how shares will be exchanged. They also mention additional share issuances to specific investors in connection with the deal. In May 2026, they held another shareholder meeting to extend the deadline again, this time to May 2028, and to change the company name to Libity. More redemptions happened here too, and they confirmed that the $155,000 stub payment to correct the underpayment to redeeming shareholders was indeed made in May 2026. So, looking at Libity's report, it is pretty clear this company is in survival mode. They've burned through most of their initial capital, had to change sponsors multiple times, and are now facing a looming deadline to complete a merger by May 2028. The auditor's going concern warning is the most significant takeaway, suggesting they might not last another year if this blue finance deal falls through. Their new sponsor, Samara, is their only lifeline, and without their continuous funding, this company likely ceases to exist. What I'm actually looking for is whether this blue finance merger can actually happen, and if so, whether it will be enough to turn this company around, or if they will simply be absorbed into a failing entity. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Check the Discord in the description.